Decoding India's trade numbers. There is a problem with India's trade numbers right now. The numbers for November were wildly off the mark because gold imports were overcounted and overstated, creating a cascading effect of errors on all trade data. So the latest one shows that India's trade deficit has narrowed to about $22 billion. That's for December 24 from its record high level of $32 billion in November 24. So the narrowing was led by sequentially lower deficits on account of gems and jewelry, petroleum products, as well as core items. The highlight, of course, was that sharp revision to the last few months of import data for gems and jewelry, and that statistical reconciliation has pruned the cumulative merchandise trade deficit by about $9 billion between April and November 25. Now, here's the interesting part. Despite the reconciliation and correction, gold imports into India are still at a record. And there's a good reason for that, and you should hold on if you want to find out why. Economics research firm Quant Eco says two developments that could also potentially impinge upon India's trade deficit in 2025 would be the impact of fresh sanctions by the United States on Russian crude and the anticipated imposition of tariffs by the Trump administration on key trade partners, which could start as soon as next week. I reached out to Vivek Kumar, economist at Quant Eco, and I began by asking him to tell us how he was looking at the new set of trade data, to explain it to us, more importantly, and what we could take away from it as an aggregate.
As far as the surprise element is concerned, it was actually not a surprise if you think about it, because the media reports with respect to the data revision after the outsized number which was reported for November had been around for some time. Last week, the Ministry of Commerce came out with a press release stating that they are revising their numbers lower. So now the official press release, when it was supplanted with the data for December, is kind of corroborating that. And the sense is that the overall trade gap is now lower by almost $12 to $13 billion. And a large part of this is on account of correction in gold data, which is of the order of $8 to $9 billion. In some sense, the downward revision is being led by precious metals. Now, the statistics part of it, now looking at the overall question that you posed, while it is comforting that the fact that trade deficit is not as wide as what we were fearing initially or a month back, the point to note here is that gold imports are still elevated. The data for the month of November, which is for precious metals imports, still continues to be at an all-time high. So this is despite the sizable downward revision, you still have the numbers which are extremely elevated. $11.6 billion is the total import figure for November. That is at an all-time high.
So what is that figure, Vivek?
So it's $11.6 billion for the entire gems and jewelry space. And that's an all-time monthly high.
Okay, so that's a useful takeaway. So why is it?
So there are a couple of reasons why what appears to us at a broad level is that there's a humongous degree of price impact.
Any thoughts on why this is happening?
So what appears is that there is a significant degree of price impact. So if you average the price of, let's say, within the precious metal basket, if you look at gold and silver as two major commodities, these two commodities have risen by almost 26 to 27% between April to November of this financial year compared to April of November of the last financial year. So this 27% increase in the precious metal prices is getting reflected in your import data. So the sense is that predominantly it's a price impact rather than a quantity.
How are you seeing exports? So in your report, you've said that you're somewhat surprised by the contraction in crude oil exports.
Correct. So we are surprised on account of both crude oil as well as gems and jewelry exports. So crude oil exports are down almost 21% on financial year till date basis. That's a huge drop, considering the fact that your crude oil imports are not showing that kind of correction. In fact, in contrast, they are down by only about 6%. So there's a mismatch between how crude oil imports are performing and how crude oil exports are performing. Now, if you do a cross-country analysis, the major culprits in terms of where our crude oil exports are going, where you've seen deceleration in terms of growth momentum. The countries within the top 5 basket are Singapore, Australia, and US. These are the 3 major countries where our crude oil exports have shown a marked deceleration or in fact negative growth this particular financial year. Similar is the story on account of gems and jewelry. Our gems and jewelry exports have contracted by 12%, whereas our gems and jewelry imports, despite the downward revision, they have expanded by 7%. So there is the dichotomy here vis-a-vis both crude oil as well as exports and imports performance.
It's interesting that we are exporting crude oil because otherwise we are a net importer, or we import 80% plus of our requirements of crude oil, isn't it?
Yes, so the number is fairly small, you could say, but still it ranges anywhere between 10 to 20% of our total export basket compared to the import. So 10 to 20% share in the export basket is not small per se, but vis-a-vis the share that crude oil has in the import basket, it is lower.
So as we look at all these figures, so where are we in an overall sense of merchandise imports and export? I mean, how is India's trade doing right now? If I were to ask you a more 30,000 feet question.
So in terms of overall sense, so far the run rate is still higher. So if you see how the deficit has performed between April and December, last year we clocked $190 billion in terms of deficit. This year, April to December, we have clocked $211 billion. So you could say that there is a delta of $20 billion that has accrued over a span of 3 quarters. Now, if you extrapolate to the remaining quarter, which is one more quarter, you could possibly see another $10 billion or so adding up to the trade deficit. So our sense is that we could end the year somewhere close to $270 odd billion on trade deficit.
And when you say end the year, you mean the March 31st?
March 31st financial year, correct.
Right, Vivek. Thank you so much for joining me.
Thank you so much, Govindraj.